This business succession move is genius. If you're over 60 and own a business, there's a 70% chance your company won't survive the transition to the next generation, costing families millions in lost value and triggering avoidable tax bills. Let me repeat that. Most business owners lose the legacy they've spent a lifetime building simply because of one overlooked succession mistake. Every year you delay planning, the risks grow, and the window to protect your wealth narrows. In my 3 decades of guiding successful business owners through retirement, I've seen firsthand how a smart succession move can mean the difference between a thriving family legacy and a devastating financial loss. The wealthiest retirees I work with all share one strategy that secures their business, minimizes taxes, and ensures their children inherit the maximum value possible. This is educational content designed to help you make informed financial decisions. Always consult a qualified advisor for your unique situation, and remember, past performance doesn't guarantee future results. Today, I'm going to reveal the genius move that savvy business owners use to pass on their companies smoothly, protect their family, and preserve what they've built, often saving hundreds of thousands in the process. By the end of this video, you'll know exactly how to avoid the most common, costly mistakes and give your legacy the best chance to thrive. But first, let me share the critical detail that most business owners overlook. Pay close attention because what you're about to discover could change everything for your family's future. Part 1. The Hidden Risks of Business Succession, a Reality. Every owner over 60 must face. If you're like most successful business owners I've advised over the past 30-plus years, you've poured your heart, soul, and decades of hard work into building something truly valuable. You've weathered economic storms, outlasted competitors, and provided for your family and employees. But there's a reality that far too many owners overlook until it's too late. The transition of your business. What happens when you're ready to step back, retire, or pass your company on to the next generation? Let me be absolutely clear. The stakes for business succession after age 60 are higher than ever before. According to recent industry data, approximately 70% of small businesses fail to successfully sell to transition successfully to the second generation. That means only about 3 in 10 businesses make it through the first handoff. And it gets even more sobering. Of those that survive, only about 12% make it to the third generation. In dollar terms, we're talking about billions in lost value each year. The average small business owner in America has between $1 million and $5 million tied up in their company. For many of my clients, their business represents over 80% of their net worth. That's not just a statistic. That's your retirement, your legacy, and your family's financial security on the line. Now, here's the part most people don't realize. Every year that passes without a clear succession plan, the risks multiply. The Internal Revenue Service reports that nearly 60% of business owners over 60 have no formal transition strategy in place. That leaves their life's work vulnerable to sudden illness, unexpected death, or even a simple miscommunication with heirs or partners. And when something goes wrong, the fallout can be devastating. I've seen families lose over $500,000 in unnecessary taxes simply because a transition was rushed or mishandled. I've seen businesses valued at $3 million sell for pennies on the dollar, sometimes less than $500,000, because a proper plan wasn't in place. And worst of all, I've seen family relationships torn apart over unclear expectations, unfair distributions, or legal battles that drag on for years. Let me repeat that. Without a well-designed succession plan, you risk losing not just money, but the very legacy you've worked so hard to build. And the sad truth is, most business owners don't realize how vulnerable they are until it's too late. The National Federation of Independent Business found that over 80% of owners believe their business will fund their retirement, but less than 30% have taken the steps needed to actually make that happen. That gap between expectation and reality is where so much pain occurs. If you're over 60, this issue becomes even more urgent. Statistically, business owners in their 60s face a sharp increase in health risks. The Social Security Administration estimates that 1 in 4 60-year-olds will experience a major health event before age 70. That means the window to act is smaller than most people think. And when you consider that the average time needed to execute a smooth business transition is at least 18 to 24 months, the clock is ticking even faster. You might be thinking, I'm not ready to retire yet. I still enjoy running my company. That's fantastic, and many of the most successful retirees I work with stay involved for years. But here's the reality. Succession planning isn't just about stepping away. It's about protecting your options, maximizing your company's value, and ensuring that when the time comes, you and your family are in control. Not the IRS, not outside buyers, and certainly not the courts. Let's talk about the tax impact for a moment, because this is where so many owners get blindsided. If you don't have the right structure in place, your heirs could face a combined federal and state tax bill of up to 37%, 20% federal capital gains plus state taxes where applicable, of your business's value. On a $2 million company, that's $900,000 gone, often due immediately, forcing a quick sale or liquidation at a fraction of your business's true worth. I've seen retirees lose more in taxes in 1 year than they saved over their entire careers, simply because they didn't know the rules or waited too long to act. And it's not just taxes. There are legal risks, too. Without a clear succession plan, your business could get tied up in probate for years, draining resources and creating endless headaches for your loved ones. I've worked with families who spent over $100,000 in legal fees, money that could have supported grandchildren's education or funded a comfortable retirement, just to untangle a messy transition. Of course, many business owners believe my children will take over. They know the business. But here's what the data shows. Less than 1/3 of family members who inherit a business are prepared or even interested in running it. That means, without a clear plan, you risk setting your children up for failure or forcing them into difficult choices they're not ready to make. Let me pause here and emphasize, this isn't about scaring you. It's about giving you the facts so you can make the best decisions for your future. In my 30-plus years of helping retirees and their families, I've seen the heartbreak and financial devastation that comes from ignoring these realities. But I've also seen the incredible peace of mind and wealth preservation that comes from getting ahead of the problem. So, to recap, here's what we've covered so far. The overwhelming majority of business owners over 60 have no formal succession plan. The risks of waiting include massive tax bills, legal disputes, business failure, and family strife. And the window to act gets smaller every year, especially as health risks and market conditions change. If your business is worth $1 million, $2 million, or more, you owe it to yourself and your family to take these risks seriously. This is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects every situation is unique, and I strongly recommend you consult with a qualified financial advisor who understands business succession planning to address your specific needs. Remember, no strategy can guarantee a particular outcome, but being proactive is the single most important step you can take. But here's what most financial advisors won't tell you. There's a proven conservative approach used by the most successful retirees I've worked with that can dramatically increase the odds of a smooth, tax-efficient transition while protecting your legacy and your family's future. It's a strategy that, when implemented correctly, can save hundreds of thousands of dollars, minimize conflict, and ensure your business continues to thrive for years to come. The solution is simpler than you think, but most people get it wrong. In the next section, I'll show you the core foundation of this genius business succession move and why it works so well for seniors who want maximum security and peace of mind. Stay with me, because what you learn next could make all the difference for your retirement and your family's future. Part 2. The Core Foundation. Unlocking a secure, tax-smart business succession. Now that you understand just how high the stakes are when it comes to business succession after age 60, let's turn our attention to the foundation of a truly genius solution. Over my 30-plus years working with retirees who own closely held businesses, I've seen firsthand what actually works, not just in theory, but in the real world, for real people, with real families, and real legacies on the line. The core strategy I want to share with you today is what's known as a staged succession plan, anchored by a combination of a buy-sell agreement and a tax-optimized transfer structure. Let me break that down in plain English, because this isn't just legal paperwork or a financial buzzword. This is the proven conservative framework that the wealthiest and most successful business owners use to protect their life's work, minimize tax exposure, and ensure a smooth, conflict-free transition, whether the next generation wants to run the business, sell it, or simply receive its value. At its heart, a staged succession plan means you don't just hand over the keys one day and walk away. Instead, you create a clear, step-by-step roadmap for how ownership and control will shift over time, often over 3, 5, or even 10 years. This approach gives you, the owner, maximum flexibility and security. It also gives your heirs or chosen successor the time and training they need to step into leadership without the pressure of an abrupt change or the chaos that comes from unclear expectations. Now, why does this matter so much for seniors, especially those over 60 with substantial retirement savings tied up in their business? The answer is simple: risk and timing. As we age, health events become more likely, markets can turn quickly, and family dynamics often shift. By putting a staged succession plan in place, you lock in the value of your business while you're still healthy and active. You create legal and financial protections that shield your assets from sudden shocks, whether it's a health crisis, an economic downturn, or even an unexpected offer from a competitor. But the real genius of this approach comes from combining it with a buy-sell agreement, a legally binding contract that spells out exactly how ownership will transfer, at what price, and under what terms. This isn't just about paperwork. A properly structured buy-sell agreement can do 3 incredibly important things for you as a senior business owner. First, it sets a fair, pre-agreed value for your business, so there's no fighting or confusion down the road. Second, it creates a funding mechanism, often using life insurance or installment payments, so your heirs or business partners don't have to scramble for cash or take out risky loans. Third, and perhaps most importantly, it triggers automatically in case of disability, death, or retirement, protecting your family from sudden financial hardship. Let me share a couple of real-world examples drawn from my experience helping business owners just like you. I worked with a client in Ohio who owned a manufacturing company valued at $2.4 million. He was 64, healthy, and still enjoyed coming to work every day, but he knew he wanted to retire within 5 years. Together, we created a staged succession plan. Over 3 years, his daughter, who had been working in the business, would gradually take on more responsibility. At each stage, we used a buy-sell agreement to transfer a portion of ownership at a preset price, funded in part by a life insurance policy that would cover the balance in case something unexpected happened. The result? When he finally retired at age 68, the transition was smooth, the tax bill was minimized, and the business continued to thrive under family leadership. Most importantly, there was no fighting, no financial chaos, and no last-minute surprises. In another case, a couple in Texas owned a chain of retail stores worth about $3.1 million. Their children were not interested in running the business, but they wanted to maximize the value for their retirement and ensure the proceeds would support their grandchildren's education. We used a buy-sell agreement structured with a key employee and an outside buyer, staged over 4 years. This allowed the owners to gradually step back, enjoy more free time, and receive steady payments that supplemented their Social Security and IRA withdrawals. Because we planned ahead, they saved over $400,000 in capital gains and estate taxes, money that now supports their family's future, not Uncle Sam. You might be wondering, why do these strategies work so well for seniors, especially those with substantial retirement savings? The answer comes down to control, tax efficiency, and peace of mind. By staging your succession and using a buy-sell agreement, you avoid fire sale scenarios that can destroy business value. You protect your principal, the core of your retirement nest egg, by locking in a fair price and creating a guaranteed funding source. And you dramatically reduce the risk of costly legal disputes or family discord because everyone knows exactly what to expect. This approach also opens the door to powerful tax planning opportunities. For example, by transferring ownership gradually, you may be able to take advantage of lower capital gains rates, gift tax exclusions, which increased to $19,000 per recipient in 2025, or even advanced estate planning tools like family limited partnerships or grantor-retained annuity trusts. In my experience, the most successful retirees use these techniques to save anywhere from $150,000 to $700,000 in taxes, money that stays in the family, compounding for future generations. Let me pause here to emphasize once again, this is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects every business and every family is unique, and it's absolutely essential to consult with a qualified financial advisor and an experienced attorney before making any decisions. No strategy can guarantee a specific outcome, and past results do not predict future performance. But what I can tell you after working with thousands of seniors and their families is that this staged, buy-sell anchored approach has stood the test of time, even through market crashes, tax law changes, and unexpected life events. So far, we've covered the core foundation of a secure, tax-smart succession plan. Staged ownership transfer, backed by a legally binding buy-sell agreement and tailored funding structure. We've seen how this works in the real world, with real numbers and real families. And we've explored why this approach is especially powerful for seniors over 60 who want to protect their legacy, minimize taxes, and enjoy true peace of mind. Now, let me show you exactly how to implement this in your own business, step by step, with clear timelines, specific dollar amounts, and practical tips to avoid the most common pitfalls. Because the truth is, even the best strategy can fall apart without the right execution. But before you take action, you need to avoid these critical mistakes that can cost you everything you've worked for. Stay tuned, because what I'm about to share next could potentially save you hundreds of thousands of dollars, depending on your specific circumstances and years of stress. Part 3. Practical Implementation Steps. Turning your succession plan into reality. Now that you understand the genius behind a staged succession plan anchored by a buy-sell agreement, let's get practical. In my 30-plus years of guiding seniors through successful business transitions, I've learned that the real difference between a smooth, wealth-preserving handoff and a costly disaster comes down to the details of execution. So let's walk through the exact steps you need to take to put this strategy into action, using specific numbers, realistic timeframes, and real-world processes that work for business owners over 60. Let me emphasize, as always, this is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects. Every business and every family is unique, so be sure to consult with a qualified financial advisor and experienced attorney who specializes in succession planning before making any commitments. No strategy can guarantee a particular result, but what I'm about to share is the proven conservative approach that the most successful retirees use to protect their life's work. Step 1 is to get a professional third-party valuation of your business. This is not the time for guesswork or back-of-the-envelope math. You need a clear, unbiased number that reflects what your company is truly worth today, not what you hope it might be worth someday. Most business valuation firms charge between $5,000 and $10,000 for a comprehensive analysis, and the process typically takes 4 to 8 weeks. Don't cut corners here. In my experience, owners who skip this step often overestimate their business's value by 20% or more, leading to disappointment and stalled negotiations down the road. A proper valuation will consider your company's assets, earnings, market position, and even industry trends. For example, if your business is valued at $2.2 million today, that number becomes the starting point for all your future planning, whether you're selling to family, employees, or an outside buyer. Step 2 is to assemble your succession team. At a minimum, you'll need a qualified financial advisor, an experienced business attorney, and a tax professional who understands both personal and business tax issues. Many successful transitions also involve a family meeting facilitated by a neutral third party, especially if multiple heirs or partners are involved. The cost for this team can range from $10,000 to $25,000 over the course of the process. But let me tell you, this investment pales in comparison to the hundreds of thousands you could lose to taxes, legal disputes, or a failed sale. Your team will help you craft the buy-sell agreement, structure the funding, and coordinate the timeline to minimize risk and maximize value. Step 3 is to design and execute your buy-sell agreement. This is the legal backbone of your succession plan. The agreement should spell out, in detail, how ownership will transfer, who the buyers are, family, employees, or outside parties, the valuation method, payment terms, and what triggers the transfer, such as retirement, disability, or death. For example, you might decide to transfer 25% of ownership each year over 4 years, with payments of $550,000 per year if your business is valued at $2.2 million. The agreement should also specify how the purchase will be funded. Many seniors use a combination of installment payments, life insurance, or even seller financing to ensure steady income and minimize tax shocks. In my experience, a well-crafted buy-sell agreement typically takes 2 to 3 months to negotiate and finalize, but it's the single most important document you'll create in this process. Step 4 is to establish the funding mechanism that will make your succession plan work. For many business owners, this means purchasing a life insurance policy, often a permanent policy with death benefit equal to the buyout price. This ensures that if something happens to you before the plan is complete, your heirs or partners have the cash they need to buy out your share without selling the business or taking on risky debt. For a $2.2 million business, a $2 million life insurance policy might cost $12,000 to $18,000 per year for a healthy 62-year-old, but it provides priceless peace of mind and liquidity. Alternatively, you might structure the payments as a series of annual installments funded by business profits, which can provide you with a predictable income stream, often $400,000 to $600,000 per year, while spreading out the tax impact over several years. Step 5 is to communicate your plan clearly and openly with everyone involved. This is where many transitions stumble, especially in family businesses. I've seen too many owners keep their intentions secret, only for misunderstandings and resentment to explode later. Hold a family or team meeting, ideally with your advisor present, where you lay out the plan, explain the reasoning, and answer questions. This transparency reduces the risk of conflict, sets expectations, and ensures a united front as you move forward. The most successful retirees I work with always make communication a top priority, and it pays off in smoother transitions and stronger family relationships. Let me pause to address a few common concerns that I hear from seniors at this stage. Many worry, what if my children or key employees aren't ready to take over? That's exactly why a staged plan works so well. You remain involved, mentoring and guiding the next generation while gradually shifting responsibility. Others ask, what if I need to change the plan later? A well-crafted buy-sell agreement can include flexibility for unexpected events, such as health changes or shifts in family interest. And of course, many owners ask about taxes. The good news is that spreading out the sale over several years can help you stay in lower capital gains brackets and avoid triggering large one-time tax bills. For example, selling 25% of your business each year for 4 years might keep you under the $500,000 annual capital gains threshold, reducing your tax rate from 20% to 15% and saving you tens of thousands of dollars. So far, we've covered 5 essential steps: professional valuation, assembling your team, designing the buy-sell agreement, setting up the funding, and communicating the plan. Each step comes with its own timeline and costs, but together they form a proven, safety-first method that protects your principal, minimizes risk, and gives you maximum control over your legacy. Let me repeat that important point. The sooner you start this process, the more options you'll have and the more value you'll preserve. Every month you delay increases the risk that something outside your control, health, taxes, or market shifts, will force your hand and cost your family dearly. This is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects consult with a qualified financial advisor for your specific situation. No plan can guarantee a particular outcome, but these steps are the same ones used by the most successful retirees I've worked with across the country. But before you take action, you need to avoid these critical mistakes that can derail even the best-laid plans. In the next section, I'll reveal the expensive pitfalls that catch far too many business owners off guard and show you how to steer clear of them so you can protect your wealth and your family's future. Stay with me, because what you learn next could potentially save you hundreds of thousands of dollars, depending on your specific circumstances and years of stress. Part 4, Common Mistakes and Pitfalls, the Expensive Errors that Cost Retirees Their Legacy. Now that you understand the actionable steps to put a genius business succession plan in place, it's absolutely critical to shine a light on the mistakes that can quietly sabotage even the best intentions. In my 30-plus years guiding business owners through this process, I've seen that the most costly errors aren't always dramatic or obvious. Often, they're subtle missteps, overlooked details, assumptions, or shortcuts that can unravel decades of hard work and cost families hundreds of thousands, sometimes even millions of dollars. Let me repeat this because it's so important. Even the most carefully crafted succession plan can be derailed by a handful of common but avoidable mistakes. Today, I want to walk you through the most frequent and expensive pitfalls I've witnessed, the financial consequences they carry, and the warning signs you need to watch for as you move through your own transition. The first and perhaps most devastating mistake is failing to update your plan as circumstances change. Many business owners create a buy-sell agreement or succession plan and then tuck it away in a drawer, assuming it will take care of itself. But business values, tax laws, family dynamics, and health situations are constantly evolving. I've seen owners lose over $250,000 in unexpected taxes simply because they didn't revisit their plan after a major change, like the addition of a new family member, a shift in business profitability, or a change in state tax law. In one case, a client's business grew from $1.5 million to $2.8 million in value over 5 years. But the original buy-sell agreement was never updated. When the owner passed unexpectedly, the outdated agreement forced the sale of the business at the old, much lower price, costing the family more than $1.3 million in lost value. The warning sign here is simple. If you haven't reviewed your succession documents in the past 2 years, you're at risk. Make it a point to schedule a formal review with your advisor and attorney every 18 to 24 months, or whenever a significant change occurs in your business or personal life. The second expensive pitfall is underestimating the true tax impact of your succession plan. Taxes are often the single largest expense in a business transition, Yet many owners focus solely on the sale price, not realizing how much will be lost to federal and state taxes. For example, selling a $2 million business in a single lump sum could trigger a combined capital gains and state tax bill of up to $600,000, depending on your location and how the sale is structured. I've seen families forced to sell business assets or take out loans just to cover an unexpected tax bill. The most successful retirees I work with always consult with a tax specialist to model out the tax consequences of different sales structures. Installment sales, partial gifts, or using trusts can often reduce the tax hit by $100,000 or more. The warning sign here is any plan that doesn't include a detailed tax projection. If your advisor hasn't shown you a line-by-line breakdown of your estimated tax liability, you're flying blind and could be in for a very costly surprise. The third common mistake is neglecting to secure proper funding for the buy-sell agreement. Too many owners assume their heirs or business partners will figure it out when the time comes, only to discover that there's not enough liquidity to complete the purchase. This can force a fire sale of the business at a steep discount, or worse, lead to drawn-out legal battles that drain both money and morale. I recall one case where a business valued at $1.8 million was supposed to be bought out by a key employee, but the funding mechanism, a life insurance policy, was never actually put in place. When the owner passed unexpectedly, the employee couldn't raise the cash and the business was sold to an outside buyer for just $900,000, costing the family nearly $900,000 in lost value. The warning sign here is any plan that lacks a clearly documented, fully funded buy-sell mechanism. Ask yourself, if something happened tomorrow, is there cash available through insurance, installment payments, or other sources to complete the transfer at full value? The fourth, and perhaps most overlooked, pitfall is poor communication with family members and key stakeholders. I've seen families torn apart, relationships destroyed, and businesses lost because the owner failed to clearly explain their intentions and the rationale behind their decisions. In one situation, two siblings were left in the dark about their father's succession plan. When he passed, confusion and resentment erupted, leading to a costly court battle that consumed nearly $200,000 in legal fees and permanently damaged family bonds. The warning sign here is a lack of documented meetings, letters, or open discussions about your plan. The most successful retirees I work with make a point to hold family meetings, include their advisors, and ensure everyone understands the plan, even if it's uncomfortable or requires tough conversations. Let's recap what we've covered in this section. The most expensive mistakes in business succession: failing to update your plan, underestimating taxes, neglecting funding, and poor communication, can each cost you hundreds of thousands of dollars and years of stress. The warning signs are easy to spot if you know what to look for: outdated documents, missing tax projections, unfunded agreements, and silence or secrecy with your family and team. In my experience, the retirees who avoid these pitfalls are the ones who take a proactive, transparent, and detail-oriented approach, reviewing their plan regularly, modeling out taxes, ensuring funding is rock solid, and communicating openly with everyone involved. Let me repeat this for emphasis. The window to correct these mistakes is open now, but it closes quickly as time passes and circumstances change. Every month you wait increases the risk that an avoidable error will cost your family dearly. This is educational content, not personalized financial advice, and you must consult with qualified professionals to address your unique situation. No plan can guarantee a specific result, but taking action now is your best defense against these costly traps. Once you avoid these traps, you can access advanced strategies that most people never learn. Techniques that can dramatically increase your retirement income, reduce your tax bill, and preserve your business legacy for generations to come. That's just the beginning. Here's where it gets really powerful. In the next section, I'll share the insider strategies that top retirees use to optimize their succession plan, maximize tax benefits, and ensure their family's financial security for decades. Stay tuned because what you're about to learn could transform your entire retirement outlook. Part 5. Advanced Strategies and Optimization. Unlocking the full potential of your succession plan. Now that you've seen the most costly mistakes and how to avoid them, you're ready to take your business succession plan to the next level. In my 30-plus years of working with successful retirees, I've learned that the difference between a good transition and a truly great one often comes down to using advanced strategies, techniques that go beyond the basics and unlock additional value, security, and peace of mind for you and your family. Let's dive into 2 powerful but often overlooked optimization strategies that can dramatically improve both your financial outcome and your legacy. These are the same techniques industry insiders use for their own businesses, and they're particularly effective for seniors over 60 who want to maximize every dollar, minimize risk, and reduce the tax bite that so often comes with a business sale. The first strategy is integrating a grantor-retained annuity trust, or GRAT, into your succession plan. Now, I know that sounds like legal jargon, but let me break it down in plain English. A grantee is a special kind of trust that allows you to transfer business ownership to your heirs over time, while retaining a stream of income for yourself. Here's how it works. You place a portion of your business shares into the trust, and the trust pays you a set annuity, let's say $150,000 per year, for a fixed period, usually between 5 and 10 years. At the end of the term, any remaining value in the trust passes to your heirs, typically with minimal or even zero gift or estate tax. Why is this so powerful for seniors? Because it allows you to freeze the current value of your business for tax purposes, while any future growth passes to your family tax-free. For example, if you transfer $1 million worth of business shares into a GRAT, and those shares grow to $1.5 million over the trust term, that extra $500,000 can go to your heirs with little or no additional tax. In one case I handled, a client used a GRAT to transfer $2 million in business value to his children, potentially saving over $400,000 in estate taxes, depending on individual circumstances and applicable tax rates compared to a traditional sale or outright gift. The key is to work with a qualified estate planning attorney who understands the IRS rules and can tailor the trust to your specific needs. The second advanced strategy is leveraging an employee stock ownership plan, or ESOP, as part of your exit. An ESOP is a retirement plan that allows your employees to gradually purchase shares in your business, often funded by the company's own future profits. This approach can be a win-win. You receive fair market value for your shares, spread out over time, often $250,000 to $500,000 per year for a mid-sized business, while your employees gain an ownership stake and a powerful incentive to help the company succeed after you retire. But here's where the real magic happens. Under current IRS rules, if you sell at least 30% of your company to an ESOP, you may be able to defer capital gains taxes by reinvesting the proceeds in qualified replacement property. For a $2 million business, that could mean deferring $300,000 or more in taxes, money you can keep working for you rather than sending it to Uncle Sam. Plus, ESOPs can create a strong succession culture, ensuring the business remains in capable hands and the transition is gradual, not abrupt. I've guided several clients through ESOP transitions, and many report increased employee loyalty, higher company performance, and smoother handoffs than with outside sales. A third optimization technique, especially relevant for those with significant retirement savings, is combining your succession plan with a Roth IRA conversion strategy. Here's the logic. If you're selling your business in stages and receiving installment payments, say $400,000 per year over 5 years, you can use the predictable income to strategically convert portions of your traditional IRA to a Roth IRA each year. This lets you fill up lower tax brackets, reducing your long-term tax liability and creating a source of tax-free income for retirement. For example, converting $100,000 per year over 5 years could save you up to $75,000 in taxes over time, while giving you more flexibility in managing future withdrawals and Medicare premiums. The most successful retirees I work with coordinate their business sale, IRA conversions, and Social Security claiming strategies to maximize after-tax cash flow and minimize costly surprises. Let's pause to consider the tax implications of these advanced strategies. Whether you're using a GRAT, an ESOP, or a Roth conversion, the timing and sequence of each move are critical. For instance, setting up a GRAT before your business experiences a major growth spurt can lock in lower gift tax values, while waiting too long could expose your heirs to higher taxes. Similarly, executing an ESOP sale early in your succession timeline gives you more years to spread out the income and reinvest the proceeds tax efficiently. And with Roth conversions, it's all about coordinating with your other income sources, Social Security, pension, or installment payments, to avoid bumping yourself into higher tax brackets. I can't stress enough, these are sophisticated moves that require expert guidance. This is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects consult with a qualified financial advisor and estate planning attorney to tailor these strategies to your unique situation. No plan can guarantee a specific result, but these tools have a 40-plus year track record of helping retirees preserve wealth, reduce taxes, and create lasting family legacies. Here's a real-world example. One couple I worked with owned a $3 million manufacturing business. By combining a staged ESOP sale with a GRAT, they were able to sell 40% of their business to employees over 3 years, receive $1.2 million in tax-deferred proceeds, and transfer an additional $800,000 in future growth to their children with minimal estate tax. At the same time, they used the steady income to convert $300,000 of their traditional IRA to a Roth, lowering their future tax bill and giving them flexibility to manage healthcare costs and other retirement expenses. The outcome? Over $600,000 in tax savings, a thriving business under employee ownership, and a family legacy that will last for generations. Let me repeat this essential point. Advanced strategies like GRATs, ESOPs, and coordinated Roth conversions aren't just for the ultra-wealthy. Many retirees with businesses valued between $1 million and $5 million can benefit, provided they plan ahead and work with the right experts. The sooner you start, the more options you'll have, and the greater your potential savings. The key to success is getting your timing exactly right, coordinating your business sale, tax moves, and retirement income so that everything works together seamlessly. If you get the sequence wrong, you could end up paying tens or even hundreds of thousands more in taxes or missing out on valuable opportunities. But with a well-crafted, safety-first approach, you can turn your business succession into a springboard for a secure, abundant retirement. So far, we've explored advanced strategies that can dramatically enhance your succession plan. GRATs for tax-smart transfers, ESOPs for employee-driven sales and tax deferral, and Roth conversions for long-term flexibility. Each of these moves requires careful planning, expert advice, and precise timing. Building on what we just discussed, the next step is to lay out a clear step-by-step timeline for implementing your plan, so you know exactly what to do first, second, and third, and how to avoid missed deadlines or costly delays. Timing is crucial. Here's exactly when to take each action to maximize your results and protect your legacy. Stay with me, because the sequence I share next could be the difference between a good retirement and a truly great one. Part 6, Implementation Timeline and Sequence, your 90-day roadmap to a secure succession. Now that you've learned the advanced strategies that can truly transform your business succession, it's time to bring all these elements together into a clear, actionable timeline. In my 30-plus years working with retirees just like you, I've seen that the most successful transitions aren't left to chance. They follow a precise, step-by-step sequence. This not only maximizes your financial benefits, but also dramatically reduces your stress, keeps your family informed, and ensures you don't miss critical deadlines. Let's walk through a realistic 6 to 12-month implementation roadmap, though some steps can begin within 90 days. This is not just theory. These are the exact steps and time frames that the most successful retirees follow. Remember, this is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects you must consult with a qualified financial advisor and attorney to tailor this plan to your unique situation. No strategy can guarantee a particular result, but following a proven sequence puts you in the best possible position for a smooth, secure transition. First 30 days. Laying the foundation. Your journey begins with assembling your professional team and gathering all the necessary information. In the first week, reach out to a qualified financial advisor, an experienced business attorney, and a tax professional with succession planning experience. Schedule an initial meeting to outline your goals, whether you want to keep the business in the family, sell to employees, or prepare for an outside buyer. Make sure everyone on your team understands your priorities, protecting your principal, minimizing taxes, and ensuring a smooth handoff. By the end of week 2, begin the business valuation process. This typically takes between 4 and 8 weeks, but starting early is essential. A professional valuation, costing between $5,000 and $10,000, will provide the baseline number for all your planning. Don't rely on rules of thumb or informal appraisals. A third-party valuation is what buyers, courts, and the IRS will respect. During weeks 3 and 4, gather all relevant documents: recent tax returns, profit and loss statements, ownership records, and any existing buy-sell agreements or succession documents. This is also the time to review your estate plan, wills, trusts, and powers of attorney to ensure everything is up to date and aligned with your business transition goals. Days 31 to 60. Structuring your succession plan. As you enter the second month, the focus shifts to designing the legal and financial framework for your transition. By day 35, your professional team should have reviewed your business valuation and started drafting or updating your buy-sell agreement. This legal document will spell out who is buying, how much they're paying, and over what time period. For example, if you're selling a $2 million business to your chosen successors, whether family members, key employees, or other designated individuals, you might structure the sale as 4 annual installments of $500,000 each. In parallel, work with your tax professional to model the tax implications of different sale structures. This is the time to evaluate advanced strategies like grantor-retained annuity trusts, GRATS, employee stock ownership plans, ESOPs, or staged Roth IRA conversions. Ask your advisor for a detailed year-by-year tax projection. This will help you avoid costly surprises and optimize your after-tax income. By day 45, begin researching and applying for any necessary life insurance policies or other funding mechanisms. For many seniors, a permanent life insurance policy is the backbone of a buy-sell agreement, providing instant liquidity to your heirs or business partners if something unexpected happens. The underwriting process can take several weeks, so start early. For a $2 million policy, expect premiums of $12,000 to $18,000 per year for a healthy 62-year-old. By day 55, hold multiple family or stakeholder meetings over several months to ensure everyone understands and supports the transition play. This is a critical step that too many business owners skip. Invite your heirs, key employees, and professional team to a formal discussion about the plan. Be transparent about your intentions, the timeline, and the reasons behind your decisions. This meeting doesn't need to resolve every detail, but it sets the stage for open communication and reduces the risk of future conflict. By day 60, finalize the buy-sell agreement and any trust or ESOP documents. Make sure all parties sign and understand the terms. This is also the time to update your estate plan, ensuring that your business succession and personal legacy are fully aligned. Days 61 to 90. Executing the transition. The final month is all about putting your plan into action and confirming that every detail is in place. By day 65, coordinate with your financial advisor to set up the funding mechanism, whether it's the life insurance policy, installment payment structure, or ESOP trust account. Make sure that the funding is documented and accessible. For example, if you're using installment payments, set up the payment schedule in writing and confirm the first payment date. By day 70, transfer the first portion of business ownership. This might mean signing over 25% of shares to your successor, updating your company's records, and notifying any relevant authorities or stakeholders. If your plan involves a GRAT or ESOP, ensure that the necessary legal filings are completed and the trust or plan is properly funded. By day 75, review the transition with your professional team. Walk through the entire process step by step, confirming that all documents are signed, all funding is in place, and all tax strategies are being implemented as planned. This is your chance to catch any last-minute issues before they become expensive problems. By day 80, communicate the completed transition to your broader team, employees, partners, and other stakeholders. Transparency here is key. Announce the change in a way that builds confidence, reassures your team, and sets the stage for continued business success. By day 90, schedule a follow-up meeting with your professional team to review the transition, address any outstanding issues, and set up a regular review schedule, typically every 12 to 18 months. This ensures your plan stays current as your business, family, and tax laws evolve. Let's recap what we've covered. In the first 30 days, you assemble your team, start the valuation, and gather documents. In days 31 to 60, you design the legal and financial structure, secure funding, and communicate with your family. In days 61 to 90, you execute the ownership transfer, confirm all funding and tax strategies, and set up ongoing reviews. It's important to remember that deadlines matter. Waiting too long at any stage can result in lost value, missed tax-saving opportunities, or even legal disputes. The IRS, state tax authorities, and buyers all rely on clear documentation and timely filings. Every month you delay increases the risk that an unexpected event, illness, market downturn, or regulatory change could force a rushed, less favorable transition. This is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects consult with a qualified financial advisor for your specific situation. No plan can guarantee a particular outcome, but a clear step-by-step timeline puts you in control of your legacy. Even if you follow this perfectly, you might encounter these common roadblocks, unexpected challenges that can threaten your plan if you're not prepared. In the next section, I'll walk you through the most frequent implementation problems, share real-world solutions, and show you how to keep your succession plan on track no matter what life throws your way. Stay with me, because learning how to troubleshoot these issues is the final piece to building a truly bulletproof retirement strategy. Part 7. Troubleshooting and Problem Solving. Overcoming the roadblocks to a smooth succession. Even with the most carefully crafted plan and a precise timeline, the reality is that business succession rarely unfolds without a few bumps along the way. In my 30-plus years of helping retirees navigate these transitions, I've seen a handful of common challenges that can threaten even the best-laid strategies. The good news is that with the right mindset and proactive solutions, you can overcome these obstacles and keep your legacy on track. Let's walk through 3 of the most frequent roadblocks seniors face during succession, and more importantly, how to solve them. Remember, this is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects Always consult with your qualified financial advisor and attorney to address your specific circumstances. No plan can guarantee a particular outcome, but learning to troubleshoot these issues puts you in the strongest possible position. Challenge 1: Valuation disputes and market fluctuations. One of the first hurdles many business owners encounter is disagreement over the business's value, either with family members, key employees, or outside buyers. This can become especially tricky if market conditions change suddenly. For example, let's say your business was valued at $2.5 million when you began the process, but a sudden downturn in your industry 6 months later drops that figure to $1.8 million. Or perhaps a family member believes the company is worth far more than the independent appraisal shows, leading to tension and stalled negotiations. The solution here is twofold. First, always use a reputable third-party valuation firm and build a valuation adjustment clause into your buy-sell agreement. This clause allows the sale price to be updated periodically, typically every 12 or 24 months, based on current financials and market conditions. That way, you're protected from both overpaying and underselling, and everyone involved knows the process is fair and transparent. In my experience, this single step has resolved more than $1 million in potential disputes for my clients over the years. Second, set clear expectations early. Hold multiple family or stakeholder meetings over several months to ensure everyone understands and supports the transition play before the valuation is finalized, and explain how the process works, why it's necessary, and how it ultimately protects everyone's interests. The most successful retirees I work with make communication a cornerstone of their transition, which dramatically reduces misunderstandings and resentment. Challenge 2: Funding delays and liquidity issues. Another common challenge arises when the funding mechanism, whether it's life insurance, an ESOP, or installment payments, hits a snag. Maybe the life insurance application is delayed due to medical underwriting, or the business's cash flow isn't as strong as expected, making it tough to meet the agreed-upon payment schedule. In some cases, a buyer or successor may struggle to secure financing on time, threatening the entire timeline. Here's how to troubleshoot this. First, always start the funding process as early as possible, ideally in the first 30 days of your succession timeline. If you're using life insurance, work with an agent who specializes in business succession and can expedite underwriting for seniors. If installment payments are involved, structure the agreement to include a grace period or balloon payment option, giving buyers flexibility if cash flow is temporarily tight. For ESOPs or outside sales, consider securing a line of credit or bridge loan as a backup. In one case, a client's employee buyer faced a 3-month delay in ESOP funding due to bank approval issues. Because we had negotiated a $500,000 line of credit as a contingency, the sale closed on time and both parties avoided costly penalties. The key is to have a Plan B built into your agreement, anticipating delays and giving all parties clear steps to follow if funding hiccups occur. Challenge 3: Successor readiness and leadership. Gaps. Perhaps the most emotionally charged challenge is when a chosen successor, whether a family member or key employee, isn't as ready as you'd hoped to take over. This can happen for many reasons: unexpected health issues, lack of interest, or simply not having the right skills or temperament. If this situation arises in the middle of your transition, it can leave both the business and your family in a precarious position. The solution is to build flexibility and ongoing training into your plan. In your buy-sell agreement include performance milestones for successors, specific goals or benchmarks they must meet before additional ownership is transferred. For example, you might require your son or daughter to complete a management training program or achieve a certain profit margin before taking on more responsibility. If they don't meet those milestones, the agreement can trigger a pause, a reevaluation, or even an option to sell to a third party. Additionally, always have a backup successor identified. The most successful retirees I've worked with designate a secondary candidate, such as a trusted manager or outside professional, who can step in if the primary successor is unable or unwilling to continue. This not only protects your business, but also relieves family pressure and preserves relationships. Challenge 4. Tax law, changes and regulatory surprises. Finally, one of the biggest wild cards in any business succession is the risk of changing tax laws or regulations. Over the past decade, we've seen capital gains rates, estate tax exemptions, and retirement account rules shift with little warning. A plan that's tax efficient today might suddenly become much less favorable if Congress changes the rules next year. To address this, schedule regular reviews with your financial advisor and tax professional, at least every 12 to 18 months. During these check-ins, rerun your tax projections based on the latest laws and make adjustments as needed. In one real-world scenario, a client was able to save over $200,000 in estate taxes by accelerating a business transfer just before a major change in state law. The lesson is clear. Staying proactive and flexible is your best defense against regulatory surprises. Let's recap what we've covered. The most common implementation challenges, valuation disputes, funding delays, successor readiness, and tax law changes can each threaten your business succession if left unaddressed. But with proactive planning, clear communication, and built-in flexibility, you can overcome these obstacles and keep your retirement strategy on track. I want to emphasize again, this is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects consult with your qualified advisors for your specific situation. No strategy can guarantee a particular result, but mastering these troubleshooting techniques is what separates the most successful retirees from those who leave their legacy to chance. Once you master this foundation, you're ready for the next level. Advanced optimization techniques that can turn a successful transition into a true wealth-building legacy. In the final section, I'll show you how to take your plan even further, maximizing your results, scaling your strategy, and making the smart adjustments that ensure your business and your family continue to thrive for decades to come. That's just the beginning. Here's where it gets really powerful. Part 8. Next Level Actions and Optimization, Scaling, Safeguarding, and Sustaining Your Legacy. You've come a long way on this journey to a genius business succession. By now, you understand the foundational steps, have learned to navigate common pitfalls, and know how to troubleshoot unexpected challenges. But if you want to truly maximize the value of your business, protect your family's wealth, and ensure your legacy endures for generations, it's time to take your succession planning to the next level. In my 30-plus years of guiding retirees through these transitions, I've seen that the most successful families don't stop at a single transfer. They build a system that continues to grow, adapt, and safeguard their wealth long after the initial handoff. Let's talk about how you can scale your strategy, optimize results, and make the smart long-term adjustments that separate good succession plans from truly great ones. Remember, this is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects. Always consult with a qualified financial advisor and estate attorney to tailor these advanced moves to your specific circumstances. No strategy can guarantee a particular outcome, but these next-level actions have helped many of my clients preserve millions for their families while enjoying the retirement they deserve. Advanced optimization. Number 1, multi-generational wealth structures. One of the most powerful ways to scale your succession plan is by establishing a multi-generational trust structure. Rather than simply passing business ownership or sale proceeds directly to your children, you can use a dynasty trust or generation-skipping trust to protect assets for your grandchildren and beyond. These structures are designed to shield your wealth from estate taxes, creditors, and even divorce settlements, ensuring that your hard-earned assets stay in the family for decades. For example, suppose you sell your business for $3 million and place the proceeds into a generation-skipping trust. Under current IRS rules, you can shelter up to $13.99 million per individual as of 2025 from estate and gift taxes, potentially saving your heirs hundreds of thousands or even millions in future taxes. The trust can provide income for your children during their lifetimes, with the principal passing tax-free to your grandchildren. In my experience, families who adopt this strategy often see their wealth grow rather than diminish across multiple generations. Advanced optimization number 2, strategic philanthropy and charitable planning. Another next-level technique is integrating charitable giving into your succession plan. Many retirees find deep satisfaction in leaving a legacy not just for their family, but for their community or favorite causes. Tools like charitable remainder trusts, CRTs, and donor-advised funds, DFs, allow you to convert a portion of your business into a lifetime income stream, receive immediate tax deductions, and ultimately support the organizations you care about. Here's how it works. Let's say you transfer $500,000 of your business shares into a CRT before the sale. The trust sells the shares, pays you a fixed income for life, often $25,000 to $40,000 per year. And at the end of the term, the remaining assets go to your chosen charity. Not only do you avoid immediate capital gains taxes on the sale, but you also receive a substantial charitable deduction, potentially reducing your taxable estate by hundreds of thousands of dollars. I've seen clients use this approach to fund scholarships, medical research, or local community projects, all while boosting their retirement income and reducing taxes. Advanced optimization number 3, ongoing review and dynamic adjustment. The most successful business transitions are not set-it-and-forget-it events. They require ongoing review and dynamic adjustment as your family, business, and the tax landscape evolve. I encourage every retiree to schedule formal reviews of their succession plan, trust structures, and tax strategies at least every 12 to 18 months. This ensures you're taking advantage of new opportunities, such as changes in Social Security rules, Medicare options, or state tax laws, and that your plan remains aligned with your family's needs and values. For example, if Congress raises or lowers estate tax exemptions, you may need to adjust your gifting strategy. If a family member's situation changes, a marriage, divorce, or new child, you'll want to revisit your trust documents to ensure everyone is properly included or protected. And if your business continues to grow after the initial transfer, you can use additional grants, family limited partnerships, or even new buy-sell agreements to capture that value and shield it from unnecessary taxes. Scaling and diversifying your retirement income. Once your business sale is complete, it's essential to optimize how you draw income in retirement. Many retirees are surprised to learn that the sequence and source of withdrawals from your business proceeds, Social Security, IRAs, and taxable accounts can have a dramatic impact on how long your money lasts and how much you pay in taxes. The most successful retirees use a coordinated withdrawal strategy, often blending Social Security optimization, Roth IRA conversions, and tax-efficient drawdowns from their business sale proceeds. For example, by delaying Social Security until age 70, you can increase your benefit by up to 32%, potentially adding $8,000 to $12,000 per year in lifetime income. At the same time, strategically converting portions of your traditional IRA to a Roth during lower income years can save you tens of thousands in future taxes and reduce your Medicare premiums. Protecting against scams and unforeseen risks. As your wealth grows and your family's financial picture becomes more complex, it's crucial to stay vigilant against scams, fraud, and predatory financial products. Seniors with substantial assets are often targeted by sophisticated scams or pressured into risky investments that promise high returns but offer little real security. The most successful retirees I work with always keep their trusted advisors in the loop before making any new investment or financial decision. Set up safeguards such as dual signature requirements for large transactions, annual reviews of all accounts, and ongoing education for family members to keep your legacy safe. Long-term considerations, family governance, and communication. Finally, don't underestimate the power of family governance. As your succession plan unfolds, hold regular family meetings to discuss goals, review the plan's progress, and address any concerns or changes. Create a written family mission statement or set of guiding principles to help future generations understand your values and intentions. This not only minimizes conflict, but also helps your heirs become responsible stewards of the wealth and business you've worked so hard to create. Let's recap what we've covered in this section. Next-level optimization means using advanced trust structures to protect and grow wealth across generations, integrating philanthropy for greater impact and tax savings, dynamically adjusting your plan as laws and family needs change, and coordinating all your retirement income sources for maximum efficiency. It also means staying vigilant against scams and maintaining open, honest communication with your family. Remember, this is educational content, not personalized financial advice. Tax laws change frequently. The information provided reflects consult with your qualified advisors to tailor these strategies to your unique situation. No plan can guarantee a specific result, but these advanced actions have helped many retirees I've worked with create lasting legacies, minimize taxes, and enjoy true peace of mind. So far, you've learned how to build, optimize, and safeguard a succession plan that can stand the test of time. But what if you could take this even further, leveraging your experience, relationships, and resources to create new opportunities and lasting impact for your family and your community? In the conclusion, I'll show you how to turn your successful transition into a launching pad for the next chapter of your life, one filled with purpose, security, and fulfillment. Stay with me, because the best is yet to come. Over the past hour, we've covered a tremendous amount of ground together, far more than just the basics of business succession. We've explored the 8 key insights that transform a business transition from a risky, stressful ordeal into a secure, wealth-building opportunity. Understanding the high failure rates of unplanned transitions, identifying the critical tax pitfalls, building a staged buy-sell structure, assembling the right team of advisors, leveraging advanced trusts and ESOPs, following a precise 90-day implementation timeline, troubleshooting the most common roadblocks, and scaling your plan for multi-generational success. This isn't just entertainment. It's valuable financial education rooted in decades of experience helping retirees protect and grow their legacies. The knowledge you've gained could save you and your family hundreds of thousands, sometimes even millions of dollars, years of stress, and countless sleepless nights. What you've received here represents decades of expertise distilled into practical, actionable guidance. And let me emphasize, after guiding thousands of business owners through market booms and busts, I know these are the very strategies that set financially secure retirees apart from those who struggle. Now that you understand each piece, let's step back and see how they work together. The true genius of this business succession move is in the integration. When you combine a staged succession plan with a well-crafted buy-sell agreement, advanced tax planning, and ongoing review, you create a system that protects your business's value, minimizes taxes, and provides a clear, conflict-free path for your family. The compound effect is remarkable. For example, a retiree who implements this complete approach, professional valuation, staged ownership transfer, trust optimization, and proactive communication, can often preserve 20% to 40% more of their business's value compared to those who rely on a last-minute sale or informal family handoff. That can mean an extra $400,000 to $800,000 on a $2 million business, or even more for larger enterprises. This is why the most successful clients I've worked with, regardless of their starting capital, consistently outperform their peers. They don't rely on luck or hope. They follow proven systems, review their plans regularly, and adjust as needed. This big-picture approach is what separates those who enjoy a secure, dignified retirement from those who are left scrambling when life throws a curveball. So, what can you do right now to put this knowledge into action? Here are the 4 critical steps you can take in the next 30 days to start optimizing your succession and protecting your family's future. Step 1. Assessment phase. First week. Start by gathering these 3 essential documents: your most recent business valuation or appraisal, the last 3 years of business tax returns, and any existing buy-sell or succession agreements. Calculate your current position using a simple formula. What is your business worth today? What is your retirement income need? And what are your projected taxes if you sold right now? Identify your biggest opportunity area, whether it's updating your valuation, clarifying your successor, or addressing a funding gap. Step 2. Planning phase. Second week. Create your personalized timeline based on your age, health, and retirement goals. Are you looking to exit in 1 year, 3 years, or 5? Research the specific options we discussed, such as grants, ESOPs, or charitable trusts that may apply to your situation. Document your current succession strategy and compare it to what you've learned today. Where are the gaps? Where can you improve tax efficiency or reduce risk? Step 3. Professional consultation, third week. Schedule a meeting with a qualified financial advisor and a business succession attorney. Bring these specific questions. How can I minimize capital gains and estate taxes in my transition? What funding mechanisms are best for my buy-sell agreement? How can I protect my family from legal disputes or forced sales? Verify that your advisor is familiar with advanced strategies like stage transfers, grants, and ESOPs. Don't settle for generic advice. A true professional will help you customize these strategies for your unique circumstances, coordinate with your tax advisor, and keep your plan compliant with changing laws. Step 4. Implementation begins, fourth week. Start with the lowest risk, highest impact change first, often updating your buy-sell agreement or securing a new business valuation. Set up the systems and accounts needed for your new strategy, whether that's funding a trust, applying for life insurance, or creating an ESOP account. Begin tracking your progress with these simple metrics: business valuation, projected after-tax sale proceeds, and documented communication with your family and team. Success looks like having clear answers to the questions that used to keep you awake at night, and seeing your financial stress decrease week by week. Now, let's address the realities. Remember, every financial strategy carries some level of risk. The goal isn't perfection, it's optimization based on your unique situation and values. Most successful retirees implement these changes gradually over 6 to 12 months, not all at once. Don't let perfectionism or fear of complexity prevent you from making small, meaningful improvements. These are not get-rich-quick schemes. They are proven, long-term strategies that have worked for thousands of business owners through multiple market cycles. The cost of inaction is often far greater than the risk of taking the first step. If you wait too long, you may lose options, or worse, leave your family with a rushed, expensive transition. You're now part of a community of informed retirees who refuse to settle for average outcomes. The journey to financial optimization is ongoing. Markets change, tax laws evolve, and family needs shift. Commit to continuing your education and staying informed about new developments in retirement and business succession planning. Share your success stories and lessons learned with others, whether it's in the comments below, with your local business group, or at your next family meeting. You're not alone, and your experience can help others avoid costly mistakes and build lasting legacies. If this video helped clarify your retirement planning strategy, please give it a thumbs up. It helps more retirees discover these valuable insights. Share your biggest takeaway in the comments. Which strategy will you implement first, and what surprised you most? Subscribe for more in-depth retirement planning guidance that could save you thousands in taxes and legal fees. Most importantly, take action on what you've learned. Your future self, your children, and your grandchildren will thank you for the wise decisions you make today. Let me emphasize this important point. This has been educational content designed to inform your decision-making, not personal financial advice. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial and tax professionals before making significant changes to your business, estate, or retirement plan. Past performance of any strategy does not guarantee future results, and the tax implications we discussed may change based on future legislation. While this information provides a strong foundation, professional guidance is invaluable. A qualified financial advisor can help you customize these strategies for your specific situation. Tax professionals can ensure you're maximizing benefits while staying compliant, and estate planning attorneys can help with the legal aspects we've discussed. In my decades of helping retirees optimize their finances, I've seen these strategies work for thousands of business owners across different market conditions. The wealthy retirees I advise didn't get there by accident. They follow proven systems, review their plans regularly, and seek out expert guidance. What separates financially secure retirees from those who struggle is usually knowledge and implementation, not luck or timing. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Sleep better tonight knowing you have a clear plan for your future and feel confident that you're making informed decisions about your hard-earned money. Your children and grandchildren will benefit from the wisdom and diligence you show today. Maintain your independence and dignity by taking control of your financial destiny. Your experience, combined with these strategies, is a powerful advantage. The sooner you implement these strategies, the more time they have to work in your favor. Every month you delay is a month of potential optimization lost. While you don't need to rush into major decisions, gathering information and starting your planning should happen soon. The cost of inaction often exceeds the cost of making imperfect but informed decisions. Most retirees' biggest regret is waiting too long to optimize their strategies. You now have knowledge that many business owners never acquire. Use it to your advantage. What surprised you most about the strategies we covered today? Which of these approaches best fits your current retirement situation? Have you already implemented any of these strategies? Share your experience in the comments. What's your biggest concern about retirement planning that we should address next? If you could ask a financial advisor one question based on this video, what would it be? You'll know you're on the right track when your financial stress decreases and you have clear answers to the questions that used to keep you awake. The goal is progress, not perfection. Small improvements compound over time. Measure your success by increased confidence in your financial decisions and the peace of mind you feel knowing your legacy is protected. If you found this content valuable, please like, comment, and subscribe for more high-value guidance on retirement, succession, and legacy planning. Most importantly, don't just watch. Take action on what you've learned. Your future self and your family will thank you. You've invested the time, gained the knowledge, and now you have the roadmap. The next step is yours. Take it with confidence, knowing you're building a legacy that will stand the test of time.